How to invest in April. Both Basic and Ripley agree that investors should brace for more volatility in April. While wild price movements can create opportunities for people who trade frequently, particularly if there are big dips in stock prices, it can also heighten anxieties of even the most steadfast long-term investors. One way to buffer your portfolio from the impact of volatility is to diversify beyond stocks and bonds to alternative assets that have a lower correlation to these markets, Basic advises. It erodes the value of money that's not invested, while rising interest rates will decrease the value of existing bond allocations. And various stock market sectors have taken a beating this year. Our advice is to be selective in this environment, says Ripley. Being selective about specific sectors or stocks is a theme that Basic is also conveying to his clients. In addition to the year-to-date slump in the stock market, the prospect of higher interest rates to come could provide a window to buy stocks at a discount. And investors may want to think about positioning their portfolios in April to benefit from those dynamics ahead, he adds. As 2022 begins, the overriding message from almost 50 financial institutions across Wall Street and beyond is that conditions still look good. But the rip-roaring rallies powered by the reopening are history. Growth will ease. Returns will moderate. Risks abound, but so do opportunities. For the fourth year, Bloomberg News has collated and condensed the key views from dozens of investment outlooks and presents more than 500 of them below. They can be sorted by institution, asset, or theme. One topic dominates. Inflation is the most frequently cited term in our selected calls, appearing 224 times. Unsurprisingly, it's often paired with a word like higher or rising. AXA Investment Managers describes it as the key concern for 2022. And surging prices hang over nearly every scenario envisaged by the Wall Street prognosticators. While firms are divided over how transitory inflation will ultimately prove, with many expecting it to ease alongside supply chain pressures. That very uncertainty feeds a consensus that one of the biggest risks this year will be monetary policy missteps. For Fidelity, the margin for error will be fine, making the probability of policy mistakes high. The expectation is for policy to tighten and yields to rise, and variations of the terms rising rates and higher yields appear throughout. With bond returns expected to be negative, fixed income trades veer into ever more complicated territory. Like collateralized loan obligations, which Federated Hermes touts for their complexity premia. Part of the issue is that valuations are elevated for all major asset classes relative to history, according to Goldman Sachs. That feeds into the less of the same mantra coined by Pictet Asset Management. When everything already looks expensive, the expected upside is smaller. Single-digit stock returns are the broad consensus. COVID gets just 36 mentions in our selected calls. As BNY Mellon Wealth Management puts it, the hope is that vaccines mean the world is turning the corner from pandemic to endemic. The word China appeared more than twice as often, with a slowdown in the world's second-largest economy seen as a major risk. Unpredictable domestic policy out of Beijing was a frequently cited headache, while the likes of Bank of America flagged the extreme downside risk of a flare-up over Taiwan.